All right, folks, welcome back. Section 3 of the Interbank price delivery algorithm data ranges. There was two main details that I missed. Remember in the first section, in which you probably got the same thing from that first teaching that I ever taught about Interbank price delivery algorithm data ranges, was I kind of taught it in the sense of telling you whenever 60 days has elapsed or whenever there's a new shift, price is supposed to shift like literally reverse, in which Normally normally, and according to price and what's the word? There's a certain word. Evidently, according to price action, of course, price could do that, okay? But NQ, this bad boy, is a rising asset. It's not gonna stop rising. I mean, just look at it. It's not gonna stop rising. No matter if it comes down, it's gonna yeah. You get the point, don't you? Okay. Just making sure you get the point. So since this bad boy is a rising asset, and not even saying that this just goes for NQ, but it makes more sense here. You're normally not going to see the if the shifts reverse or quote unquote shift, as for some reason taught it like that before. I was in a hotel lobby just typing stuff and recording, so that's probably why I taught it that way. But anyway, we're here revising my mistakes. Basically, do not expect that. Okay, use actual price action, actual confluences, actual concepts, institutional order flow, algorithmic delivery, everything you need to actually look at price and say, this next if the shift is coming up. Would it make sense to anticipate a actual shift in market structure, like a shift in order flow, or for price to simply temporarily make a new narrative to keep going? Because price can do that. Like right now, we still don't know. Well, actually, we can anticipate right now. I haven't even done analysis in like the past 2 weeks, dude. I'm not gonna lie. I still have my same like. Look, I'll just show you. I still have my same analysis from like a long time ago. I haven't analyzed in a minute because I've just been doing a whole lot of stuff. But actually going into price and looking at it and getting evidence on what price wants to do for this next if the shift is what you should do. Okay, because I taught it in the sense of like saying this is the holy grail and basically this will give you whatever price needs to predict this narrative, in which that's partially true if you use other confluences with it and other concepts, but I just taught it as if this was the holy grail, in which it's not. You need to pair everything together, whatever you use, whatever you are, whatever you put your trust in to trade with, you must combine it with other things. This is just period. You can't just say, oh, price touched the, I don't know, the 20 period VWAP or 30 period moving average and say, "Oh, okay, I'm gonna go long." Not even retail traders do that. They don't do that. So why would you do that as a smart money trader? You know what I'm saying? And then another thing, right? Remember how I said when looking back in the 20, 40, and 60-day ranges, how you can find liquidity points such as near term for 20-day, short term for 40-day, and intermediate term for 60-day? I did say that, right? You do remember me saying that if you did watch the first section? Okay, okay, just making sure. Since you remember me saying that, if you find a liquidity point outside of the 60-day range, obviously you're not supposed to look at it, right? But, but, if it has some sort of high probability to it, or just evidence and confluences that are saying that it could possibly be hit, and it's like a higher probability target than just a regular low like this right here, then of course, market. Like for example, well, I can't even say for example because this is a rising asset and anything outside the 60-day range would be all the way down here. And you get the point. It just wouldn't make any sense to go backwards if there's no backwards price action to find a target at. You get what I'm saying? So there is no for example, but you get the point, right? If you find like, let's say, okay, looking at the 20-day range, right? We have this low right here. This is a short-term low. So price can come down, take this low in the short term just to take it for a liquidity purge, in which it does exactly that. Actually, I didn't even peep that, but it does exactly that with that short-term swing. Okay. Now let's jump all the way to the 60-day range now, right? And now since we took out or manipulated, quote unquote, let's say we're looking for buy side now. We have, well, really, this is the only point of buy side we have, honestly. That's not even within it. Well, yeah, it's within the 20-day range cast forward right there. That's the 20-day range cast forward. But let's say, for example, let me get my drawing tool. Let's say, for example, we had a bunch of highs up here or whatever, and we had a whole bunch of stuff up there, right? It's outside of the 60-day range, yes. So normally we wouldn't consider it. But since it looks like it's a bunch of, you know, bunched up highs together or just relative equal highs, we could say, hold on, even though it's outside of the 60-day range, we could consider this as liquidity because just look at it. It's a whole bunch of highs together. It's relative equal highs. It's smoothness in the market that the algorithm wants to make rigid. Simple as that. Now, I don't think I have to explain that too much because it's super, super simple. If it's outside of the 60-day range and it looks good according to other confluences and concepts, of course, use it. Oh, I just deleted my 60-day range. I'm a goofy. Okay, hold on. One, two. There we go. All right, now let's go over some if the shift Sowie. I said Sowie. Shall we? Let me move all this over. Hold on. I'm gonna move all this over to. Oh, come on, dude. Did he even grab the line? No, I need you to grab the line, bucko. Oh, that's so stupid. Whatever. Okay, I'm moving it to April 1st, about right there. There we go. Then we're gonna move the line April 1st, okay? Of course, we have to go over some examples. I can't just sit here and teach you and not give you examples. That wouldn't make any sense. Oh, and of course, I have to drag it. Oh my. Oh, now you want to select the. Okay. I'm getting rage baited. Okay, move this out the way. I do my recording so raw. Should I stop doing this and like actually like prepare for my teachings? Should I start doing that? Probably should, because this is kind of embarrassing. Okay, there we go. Finally, Jesus Christ. All right, we have one of our if the shifts right here, as you can see, in which I should probably drag this down like by a lot. Yeah, there we go. That's whew, way better. Okay, now looking back and casting forward, and then just looking at where our line lands on April 1st. Okay. Which you can see directly on April 1st, we reverse and all the way up until the 60-day range ends, we start to chop around and just start moving crazy because that's when the next if the shift begins to form, obviously. I feel like I want to go over this example, but I feel like you're just too good at understanding this now that I really don't have to, and I can just speed through it, in which I'm going to do just that. Let's look previously to see what price has done in a 20-day range, and then looking back 20 days. We partially consolidated, came down, purged liquidity, and reached a major discount. Just from, what's that, from here, that low there, okay, because we purged liquidity right here. So from that low all the way to that high, let me get the little fib, the little premium and discount thingy. We can see that we hit a pretty deep discount. As you can see here, we hit a pretty deep discount and we had a liquidity purge from those equal lows there. So that's what happened in the 20-day range. Now looking back 40, we can see that we have a bunch of consolidation, like just straight consolidation. See that? From this range. Oh wait, that's not 40 days. What's hold on. That is not 40 days. That's 40 days. So whole lot of consolidation, right? And then moving on into the 20-day range, or which basically encapsulates. How does ICT say that word? Encapsulates. There we go. Encapsulates the 20-day range. There's a bunch of consolidation, and then the 20-day range is what contains that manipulation right here. So we got consolidation, manipulation, and then expansion. Simple power of three, right? Now going into the 60-day range, what happened here? Now 60-day range actually did something pretty interesting. Before it, right before the 60-day range, we had this run up, creating this high, which formed right inside the first day of the 60-day range, engineering liquidity. Engineering liquidity, how? Well, okay. Since we see that, let's say right now, this is the point that we're at, right? We don't see any of this previous price action right here. We don't see this manipulation. Let's say we're at this point in price right here. The reason we can say this has been engineered, right, is because if I put a line right here for buy sell liquidity, do you see where that line, not line, but do you see where that high stopped at? It stopped right there. Now, since it stopped right below that high there, what is it doing? It's creating relative equal highs. Why? For what purpose? For later. For later. What? What you mean for later? Look what price is doing. It's engineering liquidity. Okay, engineering is basically kind of sort of it creating liquidity, or it can be creating, purging, or leaving liquidity for later purposes. That's it. That's all liquidity engineering is. It's just in a simple sentence. So we are creating liquidity. So after this power of three that we are currently forming, because we have to manipulate after having such a strong run higher and then, having such crazy BS price action, we have to manipulate in some way, shape, or form, right? In which that some way, shape, or form is a nice power of three: consolidation, manipulation, and then expansion. Simple as that. Or if you want to call it distribution, it's basically the same thing, okay? In which, as you can see, right on that if the shift, right there, when that 60-day range ends, what happens? Start to expand. Start to expand. Simple, right? Simple, simple, easy. Now, of course, this is kind of disproving my point when I say not every 60 days is supposed to reverse. Situationally, and what's the other word? There's another word. I was just if it's evident in price, okay? Situationally, and if it's evident in price, it'll reverse. Okay. This is just common sense. I've taught you for a long time. If you have been with me for over a year now or a year and a half, I've taught you that you must use your common sense. I've taught you that ICT concepts are best used when you use all the concepts together or as many as you can together to get a clear understanding of what price wants to do. It's that simple. Got it? Okay. Now, we're going to go over one more example because that was just pretty quick. In which I want to make this video. I could probably end it now, honestly, because I really just wanted to talk about or touch on those two details and just wanted to give you like a quick example because I don't want to make it any longer than 15 minutes. In which, you know what? Yeah, we're going to make this quick for you. 11 minutes and 26 seconds on the clock. We're going to go ahead and end this video here. Section 3 of Interbank price delivery algorithm data ranges. Whew, that is a crazy tongue twister. Anyway, enough of me talking. I need to get back to the 7 other recordings I have pending for you, and I'll see you in the next one. Good luck and good trading.